based on the tax control triangle. And there's basically three parts of this triangle. You have the base of the triangle and then the top of the triangle, and they all represent different ways and different products and services that are taxed uniquely. So let's first focus on one that many people are familiar with, the 401k, the 403b, the SEP IRA. These are all tax-deferred programs where you put money into a structure pre-tax, so no taxes are taken out. The money then accumulates and it grows tax deferred, but then when you pull the money out, you are going to pay taxes. That's the tax deferred base of the triangle. The second base of the triangle is what we call the tax-free base. And this works a little bit, pretty much the opposite. And these are programs that you pay the tax right now, you put money into these products or services. These are things like Roth IRAs that many people are familiar with. Municipal bonds work this way, and even some cash value life insurance programs can work this way. The money will grow tax deferred, and then when you pull the money out, you'll be able to get it tax free. Many of you might be saying, well, which one's better? And the answer is, it depends. We have to know what tax rates are going to be in the future to really know which of these is better. And that's up for grabs. We don't know what's going to happen. So my suggestion is always to have a little bit of both so that we can control when our taxes are paid and what environments are better in the future. And then the top of the triangle, this is where we focus on taxable types of investments. You open up a brokerage account at a stock brokerage firm or a mutual fund company or a savings account at a bank, and you put money in after taxes. The money is fairly liquid, so you always have the ability to get to it, but the downside of that is that as taxes or interest works, you pay taxes year in and year out. And then when you sell the product or service later, if there's an additional gain, then you'll pay taxes as well. A good example of that would be you buy a stock. The dividends are taxed each and every year, but the share price goes up. And when you sell the stock eventually, you're going to pay a capital gain as well. So this tax triangle is a very critical part of the planning process in financial services. You've got to get to the point where you can control the different taxes. And the answer is there is not one right base or top of the triangle. A little bit of both based on your needs, goals, strategies, and objectives is how it works.